Chalo, good. So we are going to start now. And how many students are there, Pranav, who have joined so far? Just have a look. 21. Okay. So we are going to start. We're going to start now. Okay. Janardhan, are you there? Nirdi. Okay. And Ananya, Navya. What about others? I mean, your friends? They have not come. Okay. So, so we are going to start. Uh, and today's lecture is very important because there could be two questions which will be there from this topic. Okay. So, so you have to be all present and listening two questions, which all the questions I'll be doing in today's lecture. So, so if you do understand everything, then you will should not have any problem in attempting to end term exam, which will be there. Two questions will be from this topic, and the topic which we are going to cover today is capital gains. There are five income heads which are there in totality. Income from salaries, which we have already done. Then income from house property, which we are going to do, in our coming lecture. And again, profit and gains from business and profession, which is the most important, chapter. How the companies pay taxes. So this also we'll be covering in our next lecture. So today we are going to cover capital gains, which is the fourth head. And finally, there is a income from other sources. So this is like dividend income, interest income, all other income which are not falling under any head will come under this. And if you suppose receive saving interest on your bank account, so that is going to be charged under the head income from salaries. If you receive dividends on shares, so that is covered under income from other sources. So we're going to start now. The first, this thing. So I hope how many students have Navya have joined now? No, how many students are there altogether who have joined this thing? Just check with the Google Meet. 27. Okay, fine. So should we wait for 1 minute or should we start? Janardhan? Because this is a very important, and I want that at least more than 50% students should be there in the class. Okay, so we are just waiting. Okay, 31. Fine. So we can start now. Okay. So the first is called the holding period. We are talking about income under the head capital gains. That means you buy shares. Yeah. Anybody want to say something? Okay. So, if you buy shares, you buy, mutual funds, or you buy, a building or a land, anything, jewelry, and you sell it. And if you make a profit of that, it's called capital gains, and you have to pay tax under this head. Okay. Now, it all depends how long you are going to hold the asset. So there is a concept called holding period. Suppose, first head is equity shares listed on recognized stock exchange. If you're holding these, shares which are listed on the stock exchange for less than 12 months, then it is classified as short-term capital gain or a loss. Similarly, if you hold the asset, these shares for more than 12 months, then they are called long-term. Now, under the income tax, if you hold the asset for a long term, as defined by the income tax based on various asset classes, as we are learning that, so the tax gets reduced. For example, if you sell shares within 12 months and if you have made profits, you are subject to pay 15% tax. I'm just telling you, but we'll be covering that later on. And then if you sell those shares after 12 months, then you have to pay 10% tax. And up to 1 lakh, apart from your basic limit, it is exempt from tax. Okay. So the first head is called equity shares listed on recognized stock exchange. So here we are talking about shares which are listed on recognized stock exchange, not shares which are not listed on a stock exchange. Okay. Then we have debt mutual funds. Okay. So I think I made some change here which has not been captured. Okay. It is there now in this file. I'll just share this file again to Navya. I'll just share and you can just, upload this file because this is the relevant file. I'll just, share on the WhatsApp group again after some time. So we are talking about, the assets. Okay. Can you see the slide now? Okay. So, and how many students are now joined, Pranav, so far? Or Navya? Anybody? Okay, fine. So, we are talking about Neerdi, have you joined? Navya, sorry, I mean, Ananya, have you joined? Okay, okay. Neerdi, you're there. Okay, good. So, we are talking about, the capital gains tax. This is the second head what we are doing. In our previous lecture, we have done income from salaries, and there are five heads. We talked about income from salaries, income from capital gains, income from house property, income from other sources, and income from business and profession. So these are the five heads. And today we are doing the second head. So we are left with another three heads to go, and we have to cover that in the next two lectures or next to class Fridays when you're going to have so that we finish the course. Okay. So when you hold these assets, like suppose you sell equity shares, you have to hold them for a certain period of time and then you sell, they can be classified as short term or long term. That means if you buy shares from a listed stock exchange, that means from Bombay Stock Exchange or National Stock Exchange, and you hold these shares for just for 12 months, and I mean less than 12 months, then any capital gain which is accruing to you, you have to pay short-term capital gains tax, which is currently in India around 15%. 15%, okay? But if you hold these shares for more than 12 months, then you pay a lower tax. So if you buy shares and sell them after 12 months, then the rate of tax goes to 10% only. Long back, about 7, 8 years back, or maybe 10 years back, there was no tax. It was zero tax if you sold shares after holding them for more than 1 year. But then there's a 10% tax which was brought in, and there is a one basic limit of 1 lakh rupees also. So that means you make a capital gain up to 1 lakh, you don't have to pay tax, and that we are going to discuss more in detail as we go along. So equity shares, short term and long term. The whole idea is that if you hold an asset for a longer term, then the tax burden goes down. In a short term, the tax burden is higher, usually. Okay. Then we come to debt mutual funds. Now, I have covered debt mutual funds under two categories. The first category is up to 31st of March 2023. Okay. That was, in last year. So that time there was a classification. If you're holding debt mutual funds, for less than 36 months, and those mutual funds more than 36 months. Okay. So here the taxation, the taxation was brought down if you're holding these debt mutual funds for more than 36 months. But now that thing is gone. So debt mutual funds post 1st of April 2023, whether you hold for any period of time, then it will be classified as, you have to pay tax according to your slab rates. So there is no short-term or a long-term concept in case of now debt mutual funds. So I just repeat again, the debt mutual funds up to 31st of March 23, there's a concept of short-term and long-term. But now that concept has been taken out, and from 1st April 2023, it has become, there is no holding period concept. So if you buy and sell them, you have to pay tax as per the regular rates. So this is a very important, kind of a change which has happened post 1st April 2023, and there will be a question in your end term. Remember that. So please, when we do a question, so you have to be very careful. How do we solve that question? Okay. So then we have, the real estate, land and building. So if you are holding a building like a residential building or a land, and if you sell that land within 12 months. So the any profit arising from that sale of land is called short-term capital gain. If you sell it after 24 months, it's called long-term capital gain, or it can be either a gain or loss, whatever. Then unlisted shares. That means if you're holding shares which are not listed on the stock exchange, okay, few, such cases, uh, like private companies, okay, if you hold them, then the period is below 12 months and more than 24 months. So here, instead of 12 months, it is 24 months. Okay. So if you are selling unlisted shares within 24 months, any gain arising will be short-term capital gain. And if you sell them after 24 months, it is called long-term. Then gold, jewelry, bullion. Bullion is basically bars or blocks of, gold, like, when you say, so it's a bullion is basically bar or blocks of, bricks of gold. Okay, fine. So that's called gold, jewelry, and bullion. So here the holding period is less than 36 months and more than 36 months. That means if you hold the gold or jewelry for more than 36 months, you have to pay less tax. Okay. If you sell within 36 months, you have to pay full tax. Okay. So less than 36 months, that means short term you have to pay less tax, more tax, and long term you have to usually pay higher tax. So any other capital asset, the period again 36 and more than 36. So these are the holding period concept. Okay, as we understand, as we will do questions, so you'll understand them. Okay. Now we talk about short-term capital gain and long-term capital gain. So first is a short-term capital gain. That means if you are holding the assets for a less than the period which we have seen. So this is the pro forma. Okay, how do we compute the capital gains? So first is I'll do an example also here. The full value sale value. So at what value you have sold your asset. Okay. Then less expenditure incurred wholly and exclusively in connection with transfer. Nirdi, can you read this? What is written here? Right from here. Okay. So, you start with the full value. At what value you have, sold your, asset. Okay. Then any expenditure which you have incurred in connection with transfer, like suppose you have paid some brokerage, okay, for selling your asset. For example, you were owning a building and you sold it to someone, so you pay, generally a brokerage to the consultant or the agent, property agent, so you can reduce that. Then the net sale consideration. So that means if you sold the asset. So I'll do a question here. Okay, let's do a question here. Okay, so example. Okay, suppose the sale price of, we're talking about shares. Okay, assume the sale price of shares is 5 lakh. The brokerage which you paid to the broker is 5,000, and the purchase price when you bought those shares was 4 lakhs. Okay, then there is any cost of improvement? No cost of improvement. For example, in this case there is no cost of improvement, no exemption available, so you have just selling it. Okay, and assuming that it is a short-term capital gain, that means you have sold these shares within 1 year and they are listed shares. Okay, so here these shares are listed on recognized stock, which is not mentioned, so we are assuming they are listed stock exchange, and you paid a brokerage and purchase price, that means you bought these shares at 4 lakhs and sold them for 5 lakhs within a period of 1 year. Okay, so then how we are going to put here, you're going to say full value of sale price, so which is 5 lakhs. Okay, which is coming from here. Then less expenditure incurred, which is 5,000. Okay, fine. So you entered that. Then this is the net sale consideration. Okay, which is 5 lakh minus 5,000, which is 4 lakh 95,000. And then the cost of acquisition, which is 4 lakhs, which is given here. Okay, fine. So I can just use the formulas there also. So this is basically the 4 lakh. Okay, fine. And then cost of improvement, nothing. You have not done any improvement on these shares. So total short-term capital gain will be 4 lakh 95,000 minus 4 lakhs. So your profit is 95,000. So you have to pay tax, 95,000 rupees. So this will be no exemption. That means you are not availing any exemption. And we'll understand what are these exemptions under section 54B later on. But suppose you don't have any exemption, so you have to pay tax. Your income will be 95,000, on which you are supposed to pay tax as per your slab rates. Okay. So this is the short term. Now you can always, change this figure. Suppose the shares you bought were for example, for 6 lakhs and sold them for 4 lakhs. Then that means your short-term capital gain will be, 95,000. Okay. Short-term capital gain, this figure is actually should be this. So I'm just using this. So the formula was missing here. So here you can always, make a change and understand. Suppose it was 6,50,000. Okay. So how much, your capital gain will be 2,40,000. Okay. Now we come to pro forma for the long-term capital gains. This is the pro forma for long term. If you are holding the assets for that period which we have already studied and selling them after, say, for example, shares after 1 year, land and building after 2 years, so they are classified as long-term capital gains. Or gold, jewelry, if you are selling it after 3 years, they are called long-term capital gains. So this will, all such kinds will come under this format. So first, the format is looking the same. Full value consideration sale price. Okay, you have to mention the amount here. Less expenditure incurred for in connection with the transfer here. So this will be, the result will be net. So this minus this will be this. Okay. Suppose so we'll talk about the example later on. So then index cost of acquisition. So this is your net sale consideration. Then your cost of acquisition, at what price you bought those building or whatever. So you have to do indexation. If you bought it, say 10 years back, so you have to do indexation. You get a benefit of indexation cost. So we'll understand that. Okay. Then suppose you have, selling a building. You bought a building and you constructed another floor on that. Okay. So that's called cost of improvement. Okay. So that will come here. So then the long-term capital gain will be, the net sale consideration minus this. Okay, fine, less, and then the ultimate will be net long-term capital gains. So any exemptions under section 54, which we are going to cover. So we are just understanding the format at the moment, and then finally you arrive at what is your long-term capital gain chargeable to tax. So let's do a question here. Suppose you sold a property for 30 lakh rupees. Okay, so it will come as selling price. Then you paid a brokerage of 50,000 for selling the property. Okay, fine. And you bought this property for, say, 10 lakh rupees. Fine. So these are basically all the, part of the questions. So you sold the property for 30 lakhs. You paid a brokerage of 50,000. The original cost of acquiring the asset was 10 lakhs. And then when you bought the asset, then there is something called cost of inflation index, so which I'm going to just cover now. So when you bought it, the index was 200. When you sold, the index was 300. Okay. So then there was any cost of improvement, so you didn't do any improvement on the building and sold it. Okay. So you have no exemption also. This is the question. Okay. So I'll just show you now the cost of inflation index. So if you look at this index, okay, cost of inflation index. So here it starts with 2001, 2002. So this index has been, every year it is published by the income tax department. So they started with 2001, 2002. So actually this gets changed after some time. So the latest, the index starts from 2001, 2002. So this is called the base year. So, this is, for the financial year, and for the assessment year, 2002, the cost was treated as 100. Okay. So that means if you bought something in 2001 and 2 and sold in 2002, 3, the inflation has gone up by 5%. Okay. So if you bought at 100 and sold at 105, there will be no tax because you have just gained by 5%. Okay. And on inflation, you don't have to pay any tax. For example, let's take another example. Suppose you bought an asset, in 2001, 2002. Okay. Fine. For say, for example, I say uh, 5 lakh rupees. Okay. You bought in 2001, 2. Okay. When the index was what? 100. Fine. And you sold this in 2024, 25. Okay. Let's see what is the index in 2024, 24. 24, 25. This is, sorry, it is this is yet to be, announced. So you sold in 2023, 24. Okay, so I'm just making a change here. Okay. So this is 2023, 24. Okay. That time the index was how much? So I'm just going to put from here. The index was 348. Okay. Fine. So you purchased this land in 2001 2 and you sold in 2000 itna, for say for say 25 lakhs. Fine. So that means your if you calculate what will be the adjustment, so it will be divided by this into this. So that means uh, sorry, you purchased. Okay, I've just put it wrong. You purchased for 5 lakhs. So that means it is 17 lakh 40,000. Okay, fine. So that means your capital gain will be this. Capital gain will be this minus this. Okay. So I'm just making it. So this is, after indexation. After indexation. Cost after indexation. I'll say cost after indexation. I'll just explain again. Cost after indexation. Suppose now, you had purchased a property. Okay. Fine. For 5 lakhs. When? In 2001, 2002. When the index was 100. When you sold it at 25 lakhs. Okay. When? In 2023, 24, when the cost of inflation index was 348, which means you have to, calculate what is the cost after indexation. Okay. So how we do it basically is that I'm just going to use the formula here again. So you take this 5 lakhs into 348 divided by 100. So you'll have this thing. So formula is like this, which is given here. Index cost of acquisition is equal to original cost into the cost of inflation index of the year of sale divided by year of purchase. So you have to take when you sold it, what was the index, and when you bought it, what was the index. Multiplied by the original cost, you will get index cost of acquisition. So it is the index cost of, I'll just put the right word, index cost of acquisition. Okay. So, so you bought the land at 5 lakh rupees and sold it for 25 lakhs. Okay. How many? After 22 years. Okay. So normally the tax would have been, your capital gain would have been 20 lakhs. But the income tax says, or the government says that you don't have to pay tax on the 20 lakh rupees, which is the difference between the two. But you have to pay tax. You have to calculate the index cost of acquisition. That means you're going to see the index at both the time. So in 2001, the index was 100. At the time when you sold it, the index was 348. So that means you apply that indexation. So we'll get the index cost of acquisition, which is 17 lakhs 40,000. So that means if you are selling 5 lakh, asset, which is now, equivalent to 17 lakh 40,000. So that means your capital gain will be now this, this minus this, which will be 7 lakh 60,000. Okay. So I just use the formula to tell you. So it will be 25 lakhs minus 17 lakh 40,000. So that means the capital gain will be 7 lakh 60,000. Okay. So we'll do a question now so that you understand that. We'll go back to the long term this thing. So here I have not given the years here. So when you bought the asset, the index was 200. When you sold, the index was 300. Okay. So you can just go to the formula, this thing. So the full value of the consideration is coming from here, okay, which is coming for, that means you bought the selling price of the property was 30 lakhs, okay, and then you paid some expenditure, 50,000 rupees for the brokerage charges, okay, so which is, this 50,000 rupees, okay, and then this was the net sale consideration. So after full value, sale value minus the expenditure, which was, the expenditure, which was a brokerage. So your net sale consideration was 29 lakh 50,000. Then less cost of index cost of acquisition, which is here. Okay. If you see the formula here, which is C21 into C25 divided by C23. Okay. So we can just, so this is 10 lakhs into 300 divided by 200. So we get, so 10 lakhs has become 15 lakhs. Okay. And the formula is coming here, 10 lakhs into 300 divided by 200. Okay. So that means and there is no indexation cost of improvement. That means you have not, built up any story or any flow. You're not carried out any another expenditure. So that means the total long-term capital gains will be this much, which will be 29 lakh 50,000 minus 15 lakhs. Okay. So long-term capital gains will be 14 lakh 50,000. Now, there is no exemption because in the question nothing has been given. So that means you have to pay tax on 14 lakhs. Now, the tax rate is 20%. So if you want to calculate the tax also, we can just calculate. Okay. And then there is a 4% surcharge. Okay. So you can calculate the surcharge also. So that means the total tax liability will be, if you don't have any other income, rather if you have another income or doesn't make any difference because the tax rates are different. They are not slab rates, okay? The tax rate is 20% on long-term capital gains, okay, which we are going to study here. The tax rates of long-term capital gains and 4% cess, okay? So which means that you have to pay a tax of 3,01,600. Is it clear? Nidhi, Ananya, Janardhan, Aditi, is it all clear? Okay. Okay. Now the tax rates for long-term capital gains. Okay. So here, we applied 20%. Okay. For example, real estate, it was 20% with indexation benefit. Okay. If you can see this thing. So let's start with the current. So if you're, holding shares, okay, listed shares, and if you sell them after 1 year, then you have to pay 10% over 1 lakh. Up to 1 lakh rupees, there is no tax, and then you have to calculate 10% tax. And there is no indexation benefit in case of listed equity shares, okay, or mutual funds. So if you are buying and selling mutual funds and selling them after 1 year and you earn a capital gain, you have to pay only 10% capital gains tax. Okay, and up to 1 lakh, there is a total exemption for that financial year. So it is 1 lakh is every financial year. Okay, so if you make a profit over 1 lakh, you have to pay 10% tax. Then we have debt mutual funds. Now, if you, because there is no holding period now, so that means if you are selling them after you bought them after 1st April 2023, then they are treated as short-term capital gains. Okay, and if you have bought these mutual funds before 1st of April 2023, then it is called they are unless grandfathered. That means if you have bought the mutual funds before April 1, 2023, then your tax rate is 20% with indexation benefit. This was earlier. Okay. Now the law has changed. Now you're not entitled for any indexation benefit on debt mutual funds if you have bought them after 1st of April 2023. Okay. So any mutual funds, if you have bought them after 1st of April, you have to pay short-term capital gains tax. You have to pay, they are treated as short-term capital gain and you have to pay your normal tax as per slab rates. Okay. But if you have bought them before 1st of April, then you have to pay tax at the rate of 20% with indexation. So let's do a question here. Okay. So let's understand this through an example. Okay. And this is very important. So this is right coming in the exercise number 8. So please open up exercise number 8. So have you opened exercise number 8? Nidhi, Janardhan, Ananya? Okay. Just you have to read this, somebody. Maybe Nidhi, you have to read this question. Exercise number 8. Very important from your exam point of view. So I would like that everybody should open this Excel sheet uh, on their laptops and start understanding how it has been solved. Okay, fine. So this is the question. Okay, so very important question, and you should know about this. Because when you are buying or selling debt mutual funds, there was a change in the law. Okay, any debt mutual funds which you have bought after 1st of April 2023, there is no indexation benefit. But before that, if you have purchased and sold and you're going to sell now, you will get indexation benefit. That means if you bought them, say in 2021 and selling them in this year, then you have to, pay tax. You will be entitled for the indexation benefit. Okay, fine. So that is what this says. So, it's a very important provisions. Okay. So first we will talk about that. This is the details. Okay. So the question details have been put here. So Pranav, can you read these details? Okay. So this is the box which, where I captured all the details which is mentioned in the question. So the question will be given like this only in your exam. Okay. This box you have to make. Okay. Just read this. Okay, just hold on. Maybe that I have to make a change here. So this has to be 25. So you can also make a change. This should be 25. Then only it will be taxed under this year. Okay, so make it 25. Okay. So this is a small change which I am making. So you bought because both have been sold in 2025. Okay, it's not a 1 year gap. Otherwise, they will be taxed in different years. Okay, fine. So sale date is. Can you read this again? Have you all noted what I have done? Absolutely, absolutely. Because they have to be sold in the same year. Okay, then only you have to pay tax. It will fall, under the tax liability of the assessment year 25-26. Okay. So is this all clear? So other income for 25-26 assessment year is 7 lakhs. So now, first taxability of investment. So here also I am changing to 25. Fine. So here also you can make a change. Okay. So holding period is more than 3 years. Okay. So that means you bought them in 2021 and sold them in 2025. So that means you have held the asset for more than 3 years. Is it okay, Pranav? It's fine. And this is Yeah, and this is pre-April 2023. So that means this investment was made before 2023. Okay. So that means you will be entitled for indexation benefit because this was purchased before. So the CII is given 301 and 348. At the time when you purchase, it was this, and sale, it is 2000. Here also you can just make it 25. Okay. And make it 24 here. Okay. Fine. Fine. So this is 24, 25 and 348 and this thing. Okay. Fine. So this was sold in 24, 25 and bought in 21, 2020, 21. Okay. Here also you have to make a change 24, but I'll send you the latest version. Okay. Fine. So 348. Now you have bought it for 3 lakhs. Okay. So just go to the formula. You bought it for how much? The first investment you bought it for 3 lakhs. Okay. And then you sold them at 4 lakhs. Okay. Now, first you have to calculate the indexation cost, which is basically, I'm just going to remove that. So this is basically the 3 lakhs multiplied by 348. So if you can see the formula, it is C32 divided by C31, which is 348 divided by 301 into D44, which is 3 lakhs. So that means the index cost will be, because you have held the asset for more than 3 years. So that means the index cost is 3,46,000. But you bought it at 4 lakhs, isn't it? You bought it for 4 lakhs, which is mentioned here in your question, and you sold it for 3 lakhs. The index cost is 346. So that means your capital gain will be 4 lakhs 53,156, which is 4 lakhs minus 3 lakh 46,000. Okay, fine. So please note it here. You bought it at 3 lakhs. Okay, you bought it at 3 lakhs and you got the indexation benefit because it was purchased, before 1st April 2023. So you are entitled for indexation benefit. So you took the indexation benefit. The 3 lakhs worth of mutual funds are now equivalent to 3 lakh 46,844 when you are selling them. But you sold them at 4 lakhs. So the difference is 53,000, which you have earned as profit. So you have to pay 20% tax. The tax rate on long-term capital gain tax is 20%. So you have to pay 20% tax. Okay. So this is 20%. Fine. This is clear to everyone? Pranav, Janardhan, Ananya, Diya, everybody, everyone. Okay. Ashwin, Samiksha, Samya, Shagun, Shivam, have you all followed? Should I again, take you through? I can just take you through again. Okay. So first we are talking about investment number one. Okay. So we are talking about investment number one. You purchased in 2021, sold it on March 2025. So that means you have held the asset for more than 3 years. Because since you have purchased it, in 2021, so the indexation benefit will be applicable. Okay. For the second asset you have purchased on 5th April, on that you will not get the indexation benefit. So first, you'll get the indexation benefit. So you purchased at 3 lakhs, you sold at 4 lakhs. So since your holding period is more than 3 years, so and you are a resident individual, so and then you have to calculate your tax liability. So here, the indexation benefit you are going to get because you have purchased it before 1st of April 2023. Taxability of investment pre-April 2023 investment. Okay, fine. So the CIA was 301 and now it is 348 when you sold it. Okay. So when you bought it at 3 lakhs, which you can just look at from this thing. So your purchase of investment number one was for 3 lakhs. Okay. Fine. And you sold it for 4 lakhs. Okay. So this is the sale and the purchase price. Now, since you have purchased it, you are entitled for indexation benefit because you have held the asset for more than 3 years. So you are going to, calculate the index benefit, which is your 3 lakhs worth of, mutual funds are now equivalent to 3 lakh 46,844. So any profit over and above 3 lakh 46 will be treated as capital gains. Okay. So that means you bought it at 4 lakhs, you sold it at 346. The difference is 53,000. So your capital gain will be only 53,000. Okay. And you have to pay 20% tax as capital gain tax, which is 10,631. Okay. Fine. So now we come to the investment number two. Investment number two you have purchased after April 2023 and you purchased it on April 5th, 2023 and redeemed them or sold them on 5th of March 23. So which is, now here there is no indexation benefit. So your income will be charged to the normal slab rate tax. So first we are going to calculate you purchased the asset at 2 lakhs, sold it for 2 lakh 80,000. So this is your purchase price, okay, which is coming from here. So this is your purchase price and this is your sell price. So here we are going to just have a look both the sale price and the purchase price, which is given here. So the difference is the capital gains, which is, so no indexation benefit. So which will be basically 2,80,000 minus 2 lakhs. Okay. So I just repeat again, you bought it. So this is this thing. So I'm just putting here. So you bought it at 2 lakh rupees and sold it at 2,80,000, which means your total capital gain is 80,000. So here you're not entitled for any indexation benefit. So holding period less than 3 years, but per Finance Act 2023, all gains are taxed at short-term capital gains at the rate slab rate, no indexation. So that means there is no indexation benefit which will be given to you. So the difference of the two will be taxed as short-term capital gain. Now let's compute their income tax liability. Step 3, compute the income tax liability for assessment year. So now we will take what is his total income apart from short-term capital gains. So this is given in the question. Other income is 7 lakhs. This is his income other than the mutual fund income. Okay, he was working somewhere, or he's getting some salary or whatever business. So his other income is given as in total income before capital gains is 7 lakhs. Then add short-term capital gain, which is 80,000. Okay, which is this one. So he has made two earnings. So one is the short-term capital gain, another is the long-term capital gain. So we are just going to add them up first. His total income will become 7,80,000. Okay. Of course, he has made some other income which will index cost. We'll refer to that later on. So that means his total income is 7,80,000. So now we are going to calculate his tax liability on 7,80,000. On the first 2,50,000, zero tax. On the next 2,50,000, tax is 5%. On the next 10%, next 2,50,000, which is basically the difference between this. Okay, 7,80,000 minus this thing. So here basically I'm just removing it. If you add up all this, it will come to its total income. Okay, which is 7,80,000. His total income is how much? 7,80,000. So tax on 7,80,000 will be 40,500. Okay, so this is his tax on the total income, which includes his the capital gains as well as short-term capital gain. Now, the long-term capital gain is he has already invested in the second investment. The tax liability is 10,000. So we are going to add this. Okay, fine here. Investment number 1. So his total tax will be 51,131, which is the addition of this. Okay, I'm just going to do this. So 40,500 is his total tax liability on his total income, which includes other income as well as the short-term capital gain. That is the second investment. Okay, so which means his total tax liability will be 51,000 plus 4% cess. So it comes to 53,176. Okay, so this is his total tax liability. Okay, if you just go back to the question again and read the question, compute the capital gain arising from both the investments. So we have done. Calculate the tax liability of Mr. Ravi for assessment year 25-26. We have done. Comment on the difference in tax treatment for investment made before and after 23. So which is given at right at the bottom. So Pranav, can you read this at the bottom? Comment on tax treatment. Okay, so for confusion, I'm just taking this off. Okay, because there is no concept of, I mean, in case of investments bought after 1st of April 2023, there is no holding period. Okay, so you have to pay the tax as per the slab rate. Okay, no indexation benefit. Okay, read the last one. Okay, so that means it has become less favorable for higher income earners, so they have to pay tax. Earlier, they were entitled for tax at the rate of 20%, whereas the maximum slab rate is 30%. Okay, so the people who are earning high income, they have to pay tax at 30%. Okay, so now that means these people will be paying tax at 30%. Okay, because the slab rate is 30% for them if they are already earning income beyond a certain limit. Okay, is this clear?